We do think we're in a bottoming process. I know it's frustrating, and I've been in many of these markets. These are bear markets. Anything down more than 20% is a bear market. And at the turning points, it just seems so frustrating. But stick with me as I'm going through the usual drill here, and I want to give you a sense of why we think we're bottoming, and what the tug of war is out there, and how the evidence is piling up that we are probably moving into a deflationary environment. I really do believe that the Fed believes that we have a problem that might be that significant. If they didn't believe it, they wouldn't be acting this quickly. And I think they're awfully afraid of ruining their own legacies. They do not want to be known as the Federal Reserve members who presided over another big wave of inflation. And as we've been saying for quite some time, we think this inflation is more associated with the shock of COVID and the rebound and all of the distortions that took place because of it. And we're getting more and more evidence about that. Now, one of the things that concerns us is, because they are so fearful, the Fed members have taken the Fed funds rate up from 25 basis points, so 0.25%, to 250 basis points, 2.5%, in the span of a half year. That's a tenfold increase. Now, we were in a period, especially after 08-09, where the Fed was, basically laying low and just letting the economy heal. And so we had this extended period of very low interest rates, which started to change in 2017-18. And then they had to rein it back in because at the end of 2018, the economy looked like it was going to fall apart. And then, of course, in 2020, we had COVID. Nonetheless, for most of the last decade, very low interest rates, very little movement in interest rates, and now all of a sudden, a tenfold increase in short-term interest rates. Many people are using the level of interest rates to suggest that this is not really tight monetary policy. It's only 2.5% on the interest rate. But I really believe that change has been a tremendous shock to our system. Now, M2 itself, it peaked at 27% at some point in 2020, and it's down to 5.3% as of July. And given what we know about demand deposits in the banking system, it's probably going to drop to 4% in August, not leaving a lot of room for both growth and inflation to coexist. More important to us is what has happened to money supply in the last few months. It has been flat. It peaked in March, and basically it's at March's level today. That rarely happens with money supply. And so the longer it stays flat, the lower the year-over-year growth rate will go, 4.1%, 3%, and so forth, and could get to zero by the end of the year. And so we're watching that carefully. And we are, of course, wondering what the Fed's next move is. They say they're going to jack interest rates up again. And we'll talk about the employment report in a minute. But there is some fraying at the edges inside employment. And I think there's also perhaps a big seasonal factor distortion. As I've watched initial unemployment insurance claims come in the last few weeks, at the same time we're seeing one headline after another of layoffs. I'm saying this disconnect doesn't make sense. The real world is not consistent with these statistics. And it just dawned on me. I know some people have been talking about seasonal factors. in watching what has happened to claims, I do believe this may be an issue. So let me go into that. Will the Fed raise by 50 or 75 basis points? I don't know. I think if we continue to see prices fall, meaning commodity prices, and we'll go through some of them in a minute, they may go the 50, not the 75, just to signal to the markets they're perhaps not as hawkish as Chairman Powell suggested in his Jackson Hole speech. Now, the second variable, valuation, very dependent on interest rates, which in turn are dependent on inflation. And you know what we think, but the bears think we're going back to a 70s style inflation and valuations dropping to those levels. That is the essence of the fight taking place, this tug of war as we try to bottom up in the market, bottom out. I think watching prices, real-time indicators, supply relative to demand, is going to get us to the right answer faster. And right now, we'll go into it in a minute, those indicators are showing in some cases signs of collapse. On a year-over-year basis, gold prices are down 10%. Copper prices are down 21%. Lumber price had gone from $250 per unit of whatever sheath, and all the way to $1,700. Now they're back down to $486, and on a year-over-year basis, lumber prices are down. No wonder housing is in a world of hurt. Energy and food are the sticklers here. Again, Russia, Ukraine. Right now, oil prices on a year-over-year basis are up 19%. But if we stay around this level, given what happened last year to prices, we could be flat by November on a year-over-year basis. Corn today is up 24%. We know the drought and bad yields are contributing to the Ukrainian problem. We know crypto prices, they're down 60%, both Bitcoin and Ether on a year-over-year basis. And it is interesting that they're trying to stabilize in this range while other commodity prices continue to capitulate. And I'll end right now on talking about the impact of innovation on inflation. We are seeing artificial intelligence training costs dropping 60% per year. And we're seeing mind-blowing breakthroughs in artificial intelligence. So that's a huge deflationary undercurrent, and AI is going to become a part of every industry, every company. And those who harness it the most intelligently and strategically are going to be the winners. And then, with Wright's Law, which says for every cumulative doubling in the number of units produced, prices associated with each technology decline at a consistent rate, that in the industrial robotics space, that rate is 51%. In the battery space, it's 28%. In the DNA sequencing space, it's 28% for short read and 40% for long read. So we're seeing deflationary forces that are beginning to matter. Electric vehicles now, it depends where you are. In China, they account for battery electric vehicles, not even including hybrid, account for 19% of all sales. In Europe, it's 10%. In the US, it's closer to 5%. So these are beginning to move the needle now. And I think we'll be shocked at how low inflation goes and how long it stays there. Now, this is good deflation. Falling prices associated with new technologies causes booms in unit growth. We're seeing that in electric vehicles now, even though the economy is so weak. They're better, faster, cheaper, more efficient, what have you, less of a gas guzzler. So we think this is going to play out. and the surprise during the next 5 years is the deflationary undertow that we're going to be experiencing.